I want to talk about calls and the bull call spread and talk about why I prefer using the bull call spread over regular calls. So firstly, remember, before you ever enter any options trade, please make sure you know how to close it. I'll pin a video in the comment section below where I show you guys how to close out of any options trade. So let's get right into this video, guys. I want to first start by taking a look at an example of a call option, and I'm going to be using ticker symbol TSLA for today's video. So this is going to be Tesla. Again, everything I'm showing you here is just an example so that you guys can follow along. So don't copy any of these exact same trades. But let's say I wanted to buy a regular call using Tesla. Let's take a look at what that's going to look like. And then we'll go over a couple of problems that buying calls present to us. So let's go into the options here for Tesla. And let's go ahead and go over to calls. So we're already on calls and we're focusing on buying a call right now. And I'm going to leave my expiration date for tomorrow. And I'm doing this for a very specific purpose. And I'll explain that in a little bit. But let's say I wanted to buy a regular call here on Tesla. And let's say I wanted to buy the call at the $730 strike. So what I would do is I would go over here, click on this plus button, I would continue here, and I would go ahead and enter for a debit. Now, as you can see, a big problem already here is that this is going to be very expensive. It's going to cost me over $1,000. And if you're a small account, that might be a lot of money in terms of your account size. In fact, it might be even higher than your account size, right? So we already see a problem here, and that's going to be that it's very, very expensive sometimes to buy regular calls. Now, you can scroll down here and you can take a look at the P&L chart that Robinhood presents to you and kind of take a look at, how much money you might potentially make depending on the price. However, again, what I don't like about this chart is that it only shows you at expiration what your profit and losses would be. I want to know what it's going to look like days before, right? I also want to take a look at what happens with changes in implied volatility and things like that. So again, I'm going to go over to option strat now, and we're going to take a look at this exact same call, and we're going to see a couple of other problems that buying calls might have. So let's go over to option strat now. Let's go to build, and let's go to long call under basic here. And so again, we're using ticker symbol TSLA, so Tesla. We left our expiration as July 8th, and we said, okay, let's say we wanted to buy the call at the $730 strike. Now, keep in mind the data here is delayed, so it's saying it's going to cost a little bit less, but still almost $1,000. Again, that's a very big problem. That's very, very expensive. If you're a small account, you're probably not going to be able to afford that. And so let's take a look here at a couple of other problems that I see right away here. So notice here, right, if we take a look on the 7th, which is today, notice that when the market closes, right, at 3 p.m. today, if Tesla were to go up to $731, according to this, you would be up $75. But now take a look at what happens tomorrow when the market opens. If it were to open at that exact same price, you would go, according to this, from being up $75 to being down $398, even though the stock opened up at the exact same price tomorrow. Why? Because remember, buying options have theta decay. And theta decay basically loses your option value just due to time passing by. So overnight, just from time passing by, the value of your option is going to lose a lot of money, over $400, $475 here, right? And so you can always see this if you go back to Robinhood here and we actually click on this to expand it. Remember, if you look under the Greeks, you will see what theta is, negative 4.83. Right? And this is per share. Remember, each contract controls 100 shares. So you multiply this by 100, you get negative $480. So again, what that means that the value of this contract overnight, just from time passing by, it's going to lose $480. And this is one of the main reasons people lose money when they buy options, because they don't understand this concept of theta decay. So if you buy this call today, and at the end of the day you're up $75, it's around $731. And you keep it overnight, even if Tesla opens up at that exact same price, you're going to be down $400. So there's another big issue, right? So it's very expensive. Theta decay can completely crush your gains here. The other thing to understand here is that if the option has very high implied volatility and you see a decrease in implied volatility, that's also going to make your option lose a lot of money. Now, Tesla's options here aren't, they don't have that high of implied volatility, but we can still take a look here. For example, let's say that right here at $733 for Tesla, right? You're saying, hey, if we get there by 1:56 p.m., I should be up $205. But take a look at what's going to happen here. If IV were to drop to, let's say, 30%, take a look at what happens here, okay? Look at that. Now you're down $326. Why? Because again, when you buy options and implied volatility drops, the value of your option is going to lose a lot of money. So again, now we see three big things, right? Very expensive. You're going to lose money from time passing by. You're going to lose money from in a decrease in implied volatility here. The only advantage you have here, right, when you buy a call, is that your max profit is not capped. Your max profit has unlimited upside potential, right? So you could potentially make an unlimited amount here. But again, how many times when you buy a call does the stock actually shoot up a ton? Not often, right? Not often. So yes, even though it does have unlimited max profit potential, most of the time, you're taking your profit after it's gone up 2-3%, right? Now let's go ahead now and compare this to a bull call spread. So let's go back here to Robinhood and let's go back into Tesla here. So let's take a look now at what this looks like with a bull call spread. So again, a bull call spread, like the name suggests, is also going to be using calls. It's also going to be a bullish trade, but there's something a little bit different about it that's going to remove all these issues that we just saw. So let's take a look here. So let's go back into the options now, and let's take a look at an example of a bull call spread. So we're going to leave our expiration date the same. We're actually going to buy the exact same call as well so that we can compare it as closely as possible to the call that I just showed you. So let's go ahead and buy the call at the $730 strike. Now the only difference here with a bull call spread is that instead of just buying a call, you also sell a call along with it. So we would switch over to sell up here and we would sell a call with a higher strike than the call that we're buying. So one of these call options up here. Now keep in mind, the farther away you get from the call you buy, the more expensive this is going to be. So if you want it to be as cheap as possible, you would go with the one right above it. So this one right here. So I'm going to go ahead and sell this call right here. And so as you can see now, we're still entering for a debit, exactly like we did with, when we buy a call. You're still going to enter for a debit, but take a look at the cost. It's already a lot less. We went from $1,000 to now you're only going to need $140 to enter this strategy here. And again, you can kind of see what your P&L is going to look like down here at expiration, but we want to see what it looks like before expiration. We want to check what happens with changes in implied volatility and all those things. So let's go back here to option strat now. Let's go to a new tab and let's take a look at what this looks like now. So let's go to long call. And we'll start here. So again, we're using TSLA, Tesla. Our expiration we left as July 8th. Again, we started by buying a call at 7:30. And then we went ahead and I said, okay, now we need to sell a call with a higher strike. The further away you go, the more expensive it's going to be. And you can confirm this by taking a look here, right? The farther away you go, the more expensive it gets. So I'm just going to keep it as cheap as possible. I'm going to go to the strike right above it. And we have our bull call spread now. So let me go back here to the regular call. Let me just refresh this so that they're both at around the same, they have the same data here. And so now let's compare this. So again, we said right away, the first thing we noticed is that it's a lot cheaper, right? You're still entering for a debit in both situations, but this is a lot cheaper, $122 versus $1,040. Basically 10% of the price that it would cost to buy a call. So a lot less that you're risking, a lot more suitable for smaller accounts as well, right? Smaller accounts can probably afford $120 versus $1,040 here. Now, what else do we see here? Well, let's talk about the theta decay that I talked about. So again, let's say that at 3 p.m. today, right? Your, Tesla stock is at 732. According to this, you would be up $11. Tomorrow, if you let that, if you leave it overnight, you don't close out. Let's say tomorrow comes and it opens at that exact same price. What do we see here? You would still be up $11. Remember, with the regular call, what did we see? If it's at 732 and you leave it overnight and it opens at the exact same price, you'd go from being up 77 to being down $406. Now, why is this? The reason is because we're still buying a call, so we're still losing money from theta decay. But now because we're selling a call, remember when you sell an option, you benefit from theta decay. So here, right, yes, we're going to be losing $475 overnight, but we're also selling a call, meaning we're also going to make $469 overnight. So the theta here basically cancels out. And so that's why you don't suffer from theta decay here. So there's a benefit already. So we actually have two benefits, right? A lot cheaper. Now we're not going to suffer from theta decay. Now, the other thing I mentioned, remember, was decrease in implied volatility. Again, remember, if we were looking at 1:58 p.m., we would see, hey, if it's up to 734, we would be up to $209. Well, if IV suddenly drops to 30% when you're buying this regular call, what happens now? Now you're down a lot, right? $339. Well, let's take a look here now at the bull call spread. So let's say 158 comes and Tesla's at 735. According to this, you would be up $22. So what happens if IV goes down now to 30%? Take a look here, okay? So 22, if it goes down to 30%, what happens? You're actually higher now. You're actually making $37, as you can see here. And so the thing to note here about these about spreads, right? Bull call spread, any type of spread here, where you're buying and selling the same amount of options, is that most of the time, a change in implied volatility is not really going to affect you. And again, it's the same exact concept. Why? Because if we take a look here, right, when you buy a call, you want IV to go up. If IV goes down, then the value of your option drops. And again, that's due to one of the Greeks called vega. So let's say IV goes down 1% here. The value of your option is going to lose $1 or $10 actually, right? So times 100. So 16 bucks basically is it's going to lose 16 bucks when the implied volatility on this option drops 1%. But again, when you sell an option, it's the opposite. When IV goes down, you make money. So even though we buy this call, IV goes down 1%, we lose 16 bucks because of that. On the call you sold, if IV goes down 1%, then you're going to end up making money. You would end up making $16. So again, IV practically cancels each other out here. So now you're safe from a crush in implied volatility. So as you can see, with this simple bull call spread, we just fixed all those three issues we talked about with the long call. Now, we also need to acknowledge the fact that with bull call spreads, you can make insane returns. In fact, if you make your max profit here of $128, that would be a 105% return. That's an insane return, right? I think a lot of people don't like using spreads because they have capped profit. But even a 105% return, guys, is insane. Okay, we got to remember the average investor makes about 12% a year. If you're making 105% returns, that is really, really good, right? So those are still some pretty good returns, even though our profit is capped here. So anyways, that's why I prefer bull call spreads, guys. If you have any questions, feel free to leave them in the comment section below. Check out the Discord, a link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.